We still think the data justifies it. I mean, again, dual mandate, unemployment, the economy grows above trend next year, probably 2.7, 2.8% for U.S. GDP. The dollar comes down and global growth comes back.
Why would the dollar come down?
Because you're going to have a narrowing of the interest rate differential between where the U.S. is at, and as the ECB and the BOJ and everybody starts to remove stimulus, that's dollar negative.
It seems like good growth like that would keep the dollar high. You also are saying no inflation. So if it's a dual mandate, it really should be based mostly on dollar stability and inflation concerns. If inflation is not going to be part of it, why?
Dollar's not part of it, though. It's unemployment and inflation.
What? The what?
Unemployment and inflation, dual mandate.
Yes.
No, I know, but the inflation part is dollar stability. Is all that's just a code. Inflation is just a code word for
Although
currency.
Powell went way
dollar.
out of his way yesterday to say market stability is not something that they're focused on.
Not market, dollar.
But dollar market.
But that's it's just the inverse of inflation.
I get it,
so
yeah.
inflation you think is very low next year. So why raise rates just because the economy is growing at 2.8%?
Well, I think you've got inflation at the Fed's target, which is around 2%.
Or below, right?
PCE or core rates or whatever you want for the inflation. So I think they have the ammunition to slowly take that path, Joe. I mean, really, if you look at the comments yesterday, you had three things that came out of comments that were dovish, right? You had below the neutral rate. You had the Fed acknowledging that there's a time lag on the existing rate hikes that they've done. And then the Fed also acknowledging that there's no
If inflation was going to be below where the Fed's target is, would you still think they'd
then
go?
I think you could slow down.
Then you wouldn't do three increases.
And
so you're not expecting inflation to stay low. You're expecting inflation to come back. Or are you saying that 2.8% growth will translate into wage growth, which will have concerns about it?
I think you've got upward pressure on wages, but you've certainly got downward pressure on inflationary ideas like commodity prices, oil at $50. But you also have some upward pressure now on prices coming from tariffs.
Will you say, Darrell, you ignorant slut, you would never say that. Do you remember that? That's from Saturday Night Live. Do you disagree with him?
I think the difference is...
Do you disagree with him?
Absolutely. We think
that's what we want.
Two tightenings most in 2019, and then they stop. And the reason for that is the economy is going to slow down. It's not where it is today. It's where it is going to be in the first half of next year. When the stimulus fades and the tightening that they have already done kind of manifests itself in the real economy, things are going to be a lot lower from a growth standpoint than where they are right now, and inflationary pressures are going to abate. As long as that is the case, the Fed needs to stop. We are very close to the neutral rate. That's what Powell was talking about yesterday. And in that environment, once we are beyond the expectation that the Fed will continue to tighten, that is very market positive. I think that is
positive. Both of you don't think this is a correction with new highs to come in the future.
Absolutely. Again, as we have talked about before, our core theme remains 5 more years. That is, there is going to be still significant amount of growth in this cycle for quite some time.
That sounds like an election.
Well, we made it 5 more years as opposed to 4 more years for it not to be a campaign. But the point is, there's not enough inflation for it to kind of force a central bank to come down hard on the economy. And as long as that is the case, growth continues and the market cycle continues.
I think we're a long ways away from any kind of economic troubles and recession. But from the market standpoint, what I really would like to see, and we agree that this is a correction, not a new bear market, you've got to see some widening of the breadth and the leadership, right? So even yesterday on the back of Powell's comments, the resumption of leadership came from tech and healthcare, which is where it's been through the past year in this entire cycle. You need to see it spread out into industrials, into financials, into places where you can get a broader move to make that next leg higher. We think that will happen, but that's important, I think, to watch in the coming months, Joe.
But I think having said that, though, the tech sector still is going to be the leader in this cycle continuing, because these are the companies that are executing the best way. They are delivering the results in a growth short world. If you can grow at a very rapid clip, and both from a revenue and EPS standpoint, I think that's what people want.
You don't think so? You think financial? You'd favor financials over tech?
We like, we like tech, but we like our highest conviction ideas are industrials and financials right now. The valuations are about as cheap as you've got in the entire cycle. If you get any walk back on the trade tensions and the trade escalation. Industrials will light on fire. And we still think the environment looks good for the economy and credit demand into 2019.
I think the trade point is very important. If you look at the markets, there are two issues, rates and trade. And I think we are resolving the rates issue. It's really a question of getting somewhere positive on the tariff front. If we get that, then it's looking really good.
We'll see something this weekend.
Yeah, but we'll see. Whether that happens, even if it doesn't happen this time, I think if the economy slows down, the pressure on the administration to arrive at some sort of a resolution, I think, is important.
Where are you at GDP for 2019?
Slightly above 2%, so 2.2, something like that.
In 2020?
Probably 2.
And you? 2.7, 2.8 next year?
2.7 for 19, probably about 2.4, 2.5. But again, that's trend growth. I mean,
no, I know. I hear about trend all the time. I want to get out of the trend.
And if I can buy the market at 15 times forward earnings, even with a muted, I'm happy with that on an extended rally. I think you're getting some of the cheapest valuations you've had in years, quite frankly. And the reality is, I mean, look at the fourth quarter. We had the third worst start to the fourth quarter in 70 years. I mean, only 1987 and 2008 were worse, and think about what happened in 87 and 2008.